Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Verra Mobility.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So, if you look at the pre-market tape right now, Verra Mobility looks like an absolute financial crime scene.
Yeah, it's brutal.
We're looking at a violent 45% plunge. The stock is basically being cut in half before the opening bell even rings.
Right.
And, it all traces back to this single shock event, right? The abrupt termination of their automated tolling agreement with Avis.
Exactly, the Avis contract.
Yeah. Now, as an analytical investor, when you see a 45% haircut just flash across your screen, you really have to ask yourself a fundamental question.
Definitely.
Is this, the classic falling knife, like a structurally broken, toxic situation that you just need to avoid at all costs?
Right.
Or is this the ultimate contrarian value setup?
Right, where the bad news is already priced in.
Exactly. A scenario where the absolute worst-case news is ruthlessly priced in within seconds and leaves this massive margin of safety for people willing to look past the panic.
Well, it really is the ultimate test of your investment thesis. Because a 45% drop is not just a bad day in the market.
Mm-hmm. No, not at all.
It's a total structural repricing of the asset. It's highly emotional, and it violently shakes out every single weekend.
Oh, absolutely.
But the key to actually surviving and, capitalizing on these extreme market events is stepping away from the blinking red numbers. You have to look at the core mechanics of the business.
Right.
We have to separate the sudden loss of this one specific commercial contract from the broader operational reality. A growth-focused perspective demands that you look at what happens the day after the initial shockwave.
Yeah, that makes a lot of sense. You make a fair point about separating the shock from the core business. To do that, we really need to understand what this company actually brings to the table. All right, Let's move into the wealth-building context.
Good idea.
Because to understand why this stock matters for a long-term portfolio, you have to look at what they do on a daily basis.
Exactly.
They operate in two massive arenas. You've got automated tolling, and you've got municipal speed enforcement.
Yeah, the two pillars.
Right. I basically analyze this company as a modern public utility.
Yeah.
It's boring. It operates completely behind the scenes. But historically, it's been an incredibly consistent cash compounder.
Oh, massively consistent.
Like, here's how it works. You drive a rental car through a cashless toll down in Miami. They process the transaction and bill your card.
Right.
Or, you run a red light in Chicago, their physical camera catches you, and their back office software automatically issues the citation to your mailbox.
Seamlessly.
Right. But with the sudden, shocking loss of a massive partner like Avis, the immediate question I have to ask is the utility fundamentally broken? Does losing a key node in the network mean the entire plumbing system just collapses?
Well, no, the utility is definitely not broken. But the revenue mix is shifting dramatically, and you need to understand the mechanics of that shift.
Okay, walk me through it.
You have to look at the two distinct sides of this business. On one side, you have commercial services. That's where they partner with rental car giants like Avis, obviously, or large corporate fleet managers to handle the tolling logistics.
Right, and that segment just took a massive hit.
A massive, undeniable hit, yes. But on the other side, you have the government solutions segment. And this is driven by very sticky, long-term municipal contracts.
Okay.
Across the globe, cities are aggressively pushing these Vision Zero safety initiatives.
Right, the ones designed to eliminate traffic fatalities.
Exactly. And to achieve that, they require automated enforcement. They need red light cameras at busy intersections. They need speed cameras in school zones. So this government segment is an essential hard asset infrastructure play.
Yeah, that makes sense.
It is deeply embedded into how local governments operate and collect revenue. So that side of the business is fully intact. And moving forward, that is your long-term wealth-building engine.
Okay, I hear you on the government side being an engine. But, as an investor, when a stock drops by nearly half, you have to verify the structural integrity of the house before you walk inside. Now, let's look at the fundamentals.
Let's do it.
Because historically, the numbers here have been phenomenal.
Huh.
We're talking about adjusted EBITDA margins that often sit well over 40%.
It's just huge.
It's incredibly high. And for those newer to the term, adjusted EBITDA is essentially a measure of the raw cash-generating power of the company's core operations, right? Just stripping out accounting technicalities like depreciation.
Right.
And they achieve that 40% margin because their tolling infrastructure is asset-light and highly scalable. Once that digital plumbing is built, processing an extra, say, million toll transactions costs them practically nothing.
Exactly. The marginal cost is zero.
But with Avis walking out the door, that creates negative operating leverage.
True.
Meaning they lose a huge chunk of high margin revenue, but their fixed corporate costs stay exactly the same.
Yeah, the overhead doesn't shrink.
Right. So that margin mix is going to have to lean incredibly heavily on the government sector.
Well, you've hit on the core fundamental challenge there. The loss of Avis absolutely creates negative operating leverage in the short term. However, management has a very strong historical track record of operational efficiency.
Sure.
And the government solutions sector is highly profitable in its own right. But to truly understand if the fundamentals can survive this specific shock, you have to look past the profit margins and examine the actual cash generation.
Right, the balance sheet. And I have to admit, this is where my analytical caution really kicks in.
Okay, let's hear it.
Because I need you to walk me through the math here. This company carries a very significant debt load.
They do, yeah.
This is a legacy of their history as a leveraged buyout, meaning private equity bought them years ago using a massive amount of borrowed money, and that debt is still just sitting on the company's books.
Right, the LBO debt.
Yeah. And when you have high debt, a sudden 45% drop in revenue is terrifying. So how do they survive this? The only counterbalance I really see is their free cash flow.
And that's exactly where you should be looking.
Because historically, their free cash flow conversion rate is over 80% of that adjusted EBITDA we just talked about.
Yep.
Meaning for every dollar of operating profit they claim on paper, 80 cents actually ends up as cold, hard cash in their bank account.
Which is an incredible conversion rate.
It is. They generate so much cash they've been able to steadily pay down that debt over recent quarters and even fund international acquisitions, right? Like buying Redflex down in Australia.
Exactly.
So the big question is, do they actually have enough liquidity, meaning cash on hand and available credit lines, to avoid immediate disaster?
They do. They really do. And that 80% conversion rate you just mentioned, that is the absolute cornerstone of the entire bullish recovery thesis. Because even facing the severe headwind of losing the Avis volume, the core municipal business generates enough hard cash to service their debt payments and keep the lights on.
Right.
But beyond the balance sheet, if you are evaluating this as a long-term play, you also have to analyze the quality of the business model itself. The economic moat.
Right, the moat.
Historically, this company relied on incredibly high switching costs and network effects to keep competitors out.
Okay, wait, I have to push back hard on that. Because this is the glaring contradiction staring us in the face today.
How so?
If this moat is so impenetrable, if the switching costs are so impossibly high, how exactly did they lose Avis so abruptly? Well, because a moat isn't a moat if your biggest customer can just pack up and walk away overnight. Maybe Avis built an internal API, or maybe a cheaper competitor undercut them. But either way, the moat was clearly breached.
It's a totally valid challenge, and it really highlights the vital difference between their two business segments. See, in the commercial segment with Avis, the moat was built entirely on API integrations. Think of it as software talking to software.
Right.
Verra's system was the digital plumbing connecting Avis rental cars to city tolling databases. That creates switching costs, sure, but as we just saw, it is completely vulnerable to corporate fleet consolidation
Right.
or just a major corporation aggressively cutting costs.
Right. A massive entity like Avis can just decide that the cost savings of moving their toll processing in-house are worth the temporary headache of ripping out that software.
Exactly. But the government mode, that is an entirely different beast.
Also.
When a municipality installs physical cameras on their streets and wires the back office citation software directly into the local traffic court system and the DMV, the political friction and the sheer physical cost of ripping out that infrastructure is immense.
Oh, yeah, the bureaucracy alone.
Exactly. A city council is not going to dispatch crews to tear down hundreds of concrete speed cameras just to save a few pennies on vendor software fees. The government moat isn't just digital, it is literally set in concrete.
Okay, so the government moat is practically cemented in place, but moats don't pump up stock prices on their own, right? The market needs a clear spark to realize that value. That brings us to the catalyst timeline.
Yes, the catalysts.
Because if you are looking at this as a potential contrarian play, you need to know what specific events over the next 3 months could actually trigger a recovery.
Right.
A stock doesn't bounce just because it looks cheap. It needs a catalyst. And it seems the most critical event on the horizon is the upcoming earnings report.
Absolutely.
Management cannot just get on the call and read standard numbers. They need to provide what the market calls kitchen sink pro forma guidance.
And that kitchen sink approach is absolutely critical here. When management gives kitchen sink guidance, it means they need to throw every single piece of bad news out to the public all at once.
Just rip the Band-Aid off.
Exactly. They need to go on that earnings call and mathematically strip out all the Avis revenue. They must reset the baseline expectations to absolute zero for that contract. And they have to prove to the market that the remaining municipal business is stable and that their debt is perfectly secure. By lowering the bar all the way to the floor, they clear the overhang of uncertainty.
Because markets hate uncertainty even more than they hate bad news.
Bingo! Once that baseline is established, the stock can finally find a true bottom. Furthermore, management needs to go on the offensive.
Right, the conferences.
Yeah, they need to be front and center at the mid-year industrial and transportation conferences, reminding institutional investors about the defensive cash-printing nature of those municipal contracts.
And there is a massive macro trend working in their favor right now that management can lean heavily into, which is the stark reality of municipal budgets.
Also, for sure.
Across the country, cities are facing severe financial shortfalls. Infrastructure is aging, pension obligations are rising, and they are vastly underfunded.
Yeah, they need cash badly.
Right. Now think about how municipal budgeting actually works. Politically, raising property taxes or sales taxes to cover those shortfalls is incredibly unpopular. It is basically the fastest way for a mayor to get voted out of office.
Exactly.
So how do these cities generate new revenue without raising broad taxes? They rely on automated enforcement, speed cameras, red light cameras, school zone enforcement.
Yep.
It is an ironic tailwind. The tighter city budgets get, the more desperately they rely on Verra Mobility's infrastructure to generate citation revenue while simultaneously managing traffic safety.
It's a perfect storm.
Yeah, it is a macro trend that is completely untouched by whatever Avis decides to do with its rental fleet.
Absolutely untouched.
So how does this macro reality map onto the immediate price action? Now let's pivot to the chart.
Okay, let's look at the technicals.
Because the technical reality of what you are seeing today is just severe. A 45% gap down is catastrophic chart damage. You are looking at a massive structural break in the stock's trend. When a stock opens that far down, it triggers this brutal cascade of algorithmic selling.
Yeah, the bots just take over.
Retail stop losses are triggered automatically, margin calls force liquidations, and institutional algorithms just dump shares based purely on the downside volume spike. It is purely emotional, high-volume capitulation.
It looks disastrous, I know, but from a technical contrarian perspective, that exact forced panic is what creates your opportunity.
How so?
We are looking at a classic washout bottom. Event-driven capitulation violently and forcibly removes all the weak hands from the stock.
Right.
Everyone who is holding the stock tentatively, everyone who is leveraged on margin, they are completely wiped out in a single morning.
Brutal but true.
What that means for you as an investor is that going forward, there is significantly less overhead supply to cap a future rally. The sellers are exhausted because they have quite literally already sold.
I see.
It perfectly sets the stage for a mean reversion or a dead cat bounce in the short term, which then allows deep value investors to step in and establish a new base at a much more attractive valuation.
I look at a washout bottom kind of like a forest fire.
That's a good analogy.
It is devastating to watch in the immediate moment. The landscape looks completely ruined and charred. But fundamentally, a forest fire burns away all the fragile underbrush.
Right.
It completely clears out the dead wood, and the ash actually enriches the soil, allowing entirely new, resilient growth to take root from a much lower, healthier base.
Exactly.
So if the chart is a forest fire, what are the spectators doing? So what does market sentiment look like?
Well, the sentiment is pretty grim right now.
Yeah, right now, if you scroll through the news flow, the mood is overwhelmingly bearish. It is pure, unadulterated panic. And the Wall Street analysts are actively throwing fuel on that fire.
Oh, big time.
JP Morgan just came out and downgraded the stock to underweight, and they absolutely slashed their price target. They cut it from $17 all the way down to $8.
A massive cut.
I have to play the skeptic here again, though. When the smartest analysts in the room at JP Morgan downgrade a stock that aggressively, isn't that essentially Wall Street completely throwing in the towel?
It seems like it.
Why on earth would you step in front of that freight train?
It looks terrifying on the surface, yes. But you have to understand how analyst downgrades actually function during these shock events.
Okay, explain that.
Analysts risk their professional reputations if they maintain a buy rating on a stock that just cratered 45%. Therefore, severe downgrades almost always lag the actual price action.
Oh, so they're reacting, not predicting.
Exactly. The stock plummets first, and then the analyst issues a note adjusting their target to reflect the damage that has already happened.
That makes sense.
But here is the bullish pivot for contrarians. That $8 price target actually establishes a mathematically defined floor for expectations. It gives value buyers a specific level to underwrite their risk against. And if you look deeper at the institutional flow, using platforms like Whale Wisdom, you can see that prior to the shock, there was steady, heavy institutional accumulation in the smart mobility sector.
So the big money was buying in.
The smart money has historically loved this space. So at these newly depressed levels, you are going to see massive speculative flow. There is the very real potential that Verra Mobility expands their integrations with the remaining rental giants like Hertz or Enterprise to capture the market share they just lost.
Right.
There is also the possibility of securing entirely new fleet-as-a-service partners. And perhaps most importantly, at a 45% discount, this company suddenly becomes an incredibly attractive acquisition target for private equity.
Oh, because private equity owned them before.
Exactly. They intimately understand how resilient those government cash flows are. Private equity firms love predictable cash flow because predictable cash flow is what allows them to safely service the massive debt they used to buy the companies in the first place.
That makes a lot of sense. A contrarian play is only as good as its risk management, though. You can't just look at the upside. Now, let's talk about the risks.
Oh, important.
The bear case here is very straightforward, and it is very dangerous. Number one is the permanent revenue hole.
Right.
The fear is that the Avis termination isn't just a temporary negotiation tactic, but that Avis has successfully brought their tolling operations entirely in-house. Or maybe they found a dramatically cheaper competitor to do the digital plumbing.
Yeah.
If that happens, that massive chunk of market share is lost forever. It represents a permanent, unrecoverable impairment of their commercial segment.
You've isolated the primary fundamental risk there. But as a value investor, you mitigate that by looking at the price action.
Right.
The 45% pre-market drop implies that the market has already priced in that maximum permanent impairment.
So it's baked in.
Exactly. The market is currently assuming that the Avis revenue is gone forever and is valuing the company at zero for that contract. Therefore, any successful renegotiation or even a partial replacement of that volume with new commercial partners represents unexpected upside to this new, deeply depressed baseline.
Okay, fair enough. But the second major risk, and honestly the one that keeps cautious investors like me awake at night, is debt covenant risk.
Ah, the covenants, yes.
We talked earlier about their leverage balance sheet. For those unfamiliar, a debt covenant is essentially a legal tripwire set by the lenders.
Right.
The bank says, we will lend you this money, but your total debt can never be more than, say, 4 times your annual earnings.
Exactly.
If Verra's earnings suddenly drop because Avis left, that debt-to-earnings ratio suddenly spikes. And what exactly happens if they breach that covenant? It's a disaster.
It really is.
The bank can step in, it restricts their ability to buy back shares when they are cheapest, it blocks acquisitions, and in a worst-case scenario, it could force the company into a highly dilutive equity raise.
Which is terrible for shareholders.
Right, meaning issuing millions of new shares at rock-bottom prices just to raise cash, which permanently destroys value for existing shareholders.
That is the nightmare scenario for any leveraged company. A covenant breach takes control out of management's hands and gives it to the banks. However, the mitigation here comes right back to the municipal side of the business.
Okay, how so?
The incredible free cash flow generated from the government solutions segment acts as a financial shock absorber. Even under heavily stressed models where the commercial segment vastly underperforms, that steady, predictable municipal cash flow should be more than sufficient to keep them compliant with their banking covenants.
Okay, so the municipal cash flow is basically the safety net.
Exactly.
Well, we've covered the fundamental damage, the chart mechanics, and the underlying risks. Putting it all together, what are we looking at? So with everything on the table, what's the final verdict?
Based on the research, we are looking at a bullish score of 6 out of 10. This is a pure contrarian value play. The target investment horizon is a 6 to 12-month turnaround.
Makes sense.
The core thesis is this. The market is currently operating in a state of emotional panic. It's heavily overweighting the sudden loss in the commercial segment and completely ignoring the defensive cash-generating power of the government segment.
Right.
If management can stabilize the commercial side, bring in new fleet partnerships, and decisively assure the market that their debt covenants are fully compliant, this distressed valuation offers massive asymmetric upside for long-term investors.
It really is a fascinating setup to watch unfold. You know, before we wrap up today's analysis, I want to leave you with a thought that goes beyond the current balance sheet panic and looks at the horizon.
Oh, I like where this is going.
We spent all this time talking about toll processing and municipal speeding tickets. But think about the sheer staggering volume of data these physical cameras collect every single day.
It's massive.
Millions of granular data points on vehicle movement, traffic density, and municipal flow across major cities.
Right.
Beyond just mailing out traffic citations, could the true hidden future value of Verra Mobility lie in selling that real-time, granular urban traffic data to autonomous vehicle networks?
That's a really interesting point.
Right. As self-driving cars from companies like Waymo or Tesla try to map our cities and understand traffic patterns, that data becomes pure gold. It is a completely unpriced option embedded right there in their concrete infrastructure.
Wow, yeah.
If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.